Hello and welcome to 5-Year Club video number 167. Tonight we will be talking about options. Two different kinds of options. The first kind is the kind that someone uses while dealing with, say, publicly traded stocks, right? So if you hear about Wall Street and options, then you have this first kind that I'm going to talk about. An option is the right but not the obligation to buy or sell stock at a certain price. That should be buy, but instead it says but, to butt the stock at a certain price. So it's the right. You have the right to buy the stock at some price, or the right to sell the stock at a certain price to someone. And here we now come down to the specific types of options on Wall Street. A put option is an option to sell assets at an agreed price on or before a particular date. And a call option is an option to buy assets at an agreed price on or before a particular date. And so generally speaking, the amount of money that you pay for the option to buy or the option to sell is going to be a smaller amount than holding the stock itself. And because of this, their options are said to have leverage. Because, for example, if you buy an option at, say, you buy options, and the option is that you'd be able to you know what? I'm not going to go through an example because I'm too tired and I didn't already come up with one, and it's a complex thing. But trust me, you can use options to have much more gain when the market moves than you could if you had bought the stock itself. All right, so there's a term that has to do with these kinds of options called in the money. In the money means that a call option's strike price, which is the price that you would buy the stock at, is below the market price of the underlying asset, which means that you could buy it at a low price and then sell it at the market price and make money. Or that the strike price of a put option is above the market price of the underlying asset, meaning that you could buy the stock on the market and then sell it to the put option other party, and you would make money that way. An option that is in the money has intrinsic value, meaning that your options are actually worth something, and so you could actually sell your options to somebody else perhaps, or you would just be able to use the option. If the market moves in a different direction, then it could be that you would be buying the stock above the market's current price, in which case your option doesn't have any value because you would not be able to, once you buy that too expensive stock, now all you can do is sell it for a lower price, and that doesn't get you any money. All right, so why might someone want to use options in the stock market? Well, as I said before, they might want to do it if they were trying to get a lot of leverage, if they were trying to make a lot of money on something, if they were very convinced that something was going to shoot up in price and they wanted to be able to get as much gain as possible because it's a sure bet. But the more responsible use of options, right, is probably the fact that if you use the options as a protection mechanism against a stock dropping, when that stock drops, your options will go out of the money, and so they won't be worth anything. But you'll only lose the money that you paid for the options rather than money that you paid for stock. As I said before, it would have been much more expensive for you to actually buy the stock than to buy the options. So if the stock price dumps in half, then maybe you would have lost, I don't know, let's just make up numbers, $40 if you had bought the stock, but if you had bought the options, maybe you only lost $10. So it's a way of protecting yourself against loss in certain situations. They call this hedging in the business, where you would buy some stock and you'd buy some options. And basically, by buying those options, you limit your downside if the stock falls a bunch. And of course, you pay money to do that because you have to pay the price to buy those options to do that. But that's how they used. All right, now there's a different type of options called employee incentive stock options. It's a popular compensation, part of a compensation package in the tech industry in Silicon Valley. And more or less, these are the option to buy shares of your company or of your startup under certain conditions. And I'm just going to go through a bunch of the details and a bunch of the conditions. I'm not going to go really in depth about employee incentive stock options. I'm not going to go really in depth about whether or not you should buy them in different situations at different companies, because that's incredibly complicated. It's also incredibly it's not deterministic. Like, I can't tell you a rule where I have evidence that would support following that rule. Options in the startup world are just very risky, generally speaking. I personally refer to them as lottery tickets because that's how they work. Most of the time they're worthless, and some of the time they are worth a lot of money. And so I have personally not made money on any of my stock options except for one company that I've been at. So all the companies where, like my 4 previous companies, none of those options were worth anything, and except for the 4th company. Arguably the 3rd company, maybe I could have made some money there, but I didn't stay long enough to get the options, and we'll cover that right now. Okay. I'm going to paste this Wikipedia link in the description in case you want to read more about incentive stock options. But here are some things to keep in mind when thinking about your incentive stock options. Typically, these vest over 4 years with a 1-year cliff. What does the 1-year cliff means? It means that if you leave the company without staying for at least 1 year, then you are never allowed to exercise any of those options. You lose all the options. It's like they never existed. So what does it mean when I say vest? Well, the term vest means that you are allowed to exercise the option. In other words, when an option vests, you could then go to your HR or whoever you go to, and you could say, I would like to exercise my vested options. And they would then go get some paperwork that would draw up like how many options that you're buying, and you would go and get the money that you need to buy those options at their strike price, which would be listed in whatever offer letter, usually, or some future letter that talks about the price of your options. And yeah, then you hand over the money. You may get a stock certificate. They may keep the stock certificate. They may email you a copy of the stock certificate, something like that. And now you are an owner of stock, very risky stock, in a startup. Typically, options vest on a monthly schedule. So every complete new month that you stay at the company, you are allowed to exercise proportionally that many more options over 4 years. So if you started a company and you're on this typical 4-year vesting schedule, which has been the vesting schedule at every single startup I've been at, then after 2 years, for example, you would be able to purchase or exercise 50% of those initial options. After 3 years, you'd be able to exercise 75% of those options. And yeah. So now what is the strike price? Well, as I said before, I mentioned earlier, the strike price is the price that you pay per option when you exercise your stock options. The strike price of your options is going to depend on a bunch of things. It depends on what the board of directors, I think, considers the fair market value of the company, which is often based on the details of the last investment round. So the people who last invested money in the company will come up with some theoretical value for the company, and that's going to play into what the strike price is going to be for your stock options. if more people in the future invest money in the company, they may decide on a different fair market value for that company. And therefore, any options that are given out after that investment round are going to be priced at the price of the new fair market value, and your old options will remain at whatever price, whatever strike price they were at. Now, this can have some kind of interesting effects. It can mean that, like, if the strike price goes down over time, it could mean that, like, your old strike price was higher, and if the fair market value is that new strike price and it's lower than the initial price, well, then you may have, 11-cent options for a company that's only worth 10 cents. So that's not valuable because you wouldn't want to pay 11 cents for something that's only worth 10 cents. But, here's the thing, is that, like, startups are very volatile. So you may have those 11-cent options, and you may have, like, 10-cent options that are 2 years later, and then 4 years after that, the company is worth, like, $100 billion, and each share is now worth, like, $120. And so both the 10-cent and 11-cent options are very good deal. But you don't know that because you don't know how the company is going to turn out. And, that they call it an exit. That exit can happen in many different ways. The company could be acquired by a different private company. The company could be acquired by a public company. The company could go public and hold an initial public offering and sell shares to the public. And that's how you could get money out of that. So it's very complicated. And so you really don't know kind of like what the strike price means a lot of times. You can try to figure it out. You can ask them like how many shares there are total in the company. And then you can look at the company and you can say, how much do I think this company would sell for? Are there any similar companies that have sold recently? What did they sell for? And then you can just, naively say, okay, sales price divided by number of shares equals value per share. Now that's a very inaccurate, imprecise way of doing it though, because when you get money in an exit event, the amount of money you get depends upon the particulars of the investment contracts that have been executed over time to fund the company. All right, another detail is if you leave the company, you typically have 30, maybe 90 days. You have to read your contract for your options to exercise those options. If you don't exercise those options within that time period, you lose them all. This means that you need to save money. You need to save enough money such that if you were laid off or whatever the situation is, you can both cover yourself during the period where you're not making income, and you have the money that you could exercise the options if you think they're a good investment. It's kind of tragic that right at the time that you're leaving the company is a lot of times the worst time money-wise to exercise these options, but it's true, it's a fact, and we can read it in the contract so we can prepare for it ahead of time. If you have some stock options, it's another reason to save money. You want to set aside some money in case you want to exercise those options in the future. Another detail from the contract is options often expire after 10 years. Now, usually something is done before then. So usually there's an exit event or the company will kind of re-up those options to make sure that like you could still exercise them in the future if you wanted to. But most startups, the initial investors don't want that company going more than 10 years without them getting their money back. So yeah, that's just another detail to keep in mind. After 10 years, the options expire if nothing else is done. If you exercise your options, you may end up in a gnarly tax situation. I'm going to include a link at the bottom that goes into more detail about this. But basically, under the AMT tax laws, exercising the options is counted as income, and so they can charge you a bunch of tax on that income. This is especially problematic because those options are so risky, and so you could exercise the options. have to pay a bunch of tax on it, and then later the company actually just goes bust, and so now you paid tax on something and you never got a payout that would have covered that tax bill. And so there is risk associated with exercising the options for this tax reason. You would want to talk to a tax person because it is complicated. This is one of those complicated tax situations that I would not want to leave up to an amateur like me or to TurboTax. You want to talk to a tax professional who knows how to engineer this stuff to get you the maximum gain. All right, now we get into the details of some of these investment contracts. When the company is sold, who gets paid what is determined by the details of the investment contracts when people invest in the company. More or less, these investment contracts determine who, when there's an exit event and people are being paid money for their shares, there is an order in the line of people waiting to be paid. And people can put themselves ahead of you in that order because they can say, okay, you want $5 million, $50 million more for the company? Okay, fine. But if I give you $50 million more for this company, I want to be paid back first in the case that you exit. And so, yeah, there's something called a liquidation preference, for example, where if you invest $5 million in a company and you, say, have a 2x liquidation preference, that would mean that when the money is handed out, they would pay you $10 million, that's 2 times your investment, first, and then they would divide the rest of the remaining money evenly among the shareholders, right? But here's the thing. If the company only sold for $9 million, then that $10 million liquidation preference is going to absorb all of the money at that exit. And so none of the shareholders are going to get any money except for you, and then you get like $9 million. Of course, these investment contracts are very complicated oftentimes over time. And so I don't want to get too far into that, but I just want you to be aware that, just taking what you think the company would sell for and dividing by the number of shares, it's not really going to definitively tell you how much you would actually get paid in the case of an exit. And of course, if they pay, if the money runs out before it reaches you in that payment line, then you're not going to get any money. If the company has a lot of debt, that debt has to be paid off before you can get any money, oftentimes. And so therefore, if the company is deeply in debt, your options are not going to get you any money in the case of an exit. All right, so here's a detail about the taxes on the stock that you hold. All right, so there are 2 different tax rates for investments. There is a short-term capital gains rate, which I think is 35%, and a long-term capital gains rate, which is like 15 or 20%, 15% for most people, so let's stick with that. What is a capital gain? Well, a capital gain is when stock increases in value. And a short-term capital gain is when you hold the stock for less than a year, and a long-term capital gain is when you hold the stock for more than a year. So if I went out and I bought Google stock, and Google stock like doubled, and I sold it next week, then I would have made a nice amount of money, but I would need to pay 35% of that profit in taxes, and that's no fun. However, if I bought Google stock and I held it for a year and it doubled in value, then I would only pay 15% on the profit, and that's a much nicer tax rate. And so the point is, you can avoid these high taxation rates if you exercise your options at least a year before the exit. But again, this is very risky because you don't know when the exit is going to be. You just don't know. You don't know if there will ever be an exit. And so it's not a sure bet to exercise your options early because even though you do have the possibility of avoiding these taxes, you also have the possibility that the future of the company is more uncertain because it's earlier, and therefore there's just more risk in purchasing that stocks. And that brings me to my final point, is that tech stock options are risky. And so you may lose the money that you put into them. If you want to purchase them, then you need to save money now and prepare for it. You need to have that money already set aside because you don't want to be in the position of putting your whole net worth into risky options. You don't want to be in the position of leaving a job and needing money to pay for things, but then also maybe wanting to exercise the options. Broad recommendation from me is that the amount that you put into stock options should be less than 10% of your net worth because this is a risky asset class. And whatever money that you put into options, you need to be willing to lose it, and you need to tell yourself at a time, I will still be a happy person if I lose this money, because statistically speaking, you will probably lose the money. That's just a fact. That's just the truth. So yeah, that's it. That's all I have to say about them today. It's a really interesting topic, reading about how companies are funded and the different contractual terms, at least interesting to me. I think there's a guy named Brad Feldman who has a good blog on it. And Wilson, he's a VC, Fred Wilson. Or maybe it's just Brad Feld. I forgot. Anyway, point is, it's very interesting, but it's more technical than I wanted to get into here. I just wanted to review some of these things. You may have heard of them before. You may have not heard of them before. But this is kind of a broad outline of what is the deal with these options and what do you need to do? Save some money. All right, that's it for 5-Year Club video number 167. I hope you enjoyed it. Have a fabulous evening.